Okay, so let's move on to the last of the three. Okay, so it's very similar to a percentage of receivables, except we're now going to break out the accounts receivable more granularly. Okay, um, so again, it's a modification of the percent of receivables method. Okay, we're using the same concept, but we're now uh, stratifying our accounts receivable, because before it's just in one T account as like one balance. Now we're gonna have, this is the kind of the balance in the T account, this 6,375, but we're now breaking it out between these different, like, kind of aging, as it's called, how old the account receivable is. Okay, um, if it's older, is it more or less likely to be paid if an account receivable is old? Less likely, right? It means the person is just, it's lingering around. Okay, so that means, as you can see here, we're going to apply a higher percentage to this, meaning that we're assuming of this $100 that's in this tier, we're assuming that 90% of whatever's in here is going to be uncollectible. Okay, because we're assuming if it's gone this far in age, then it's just uncollectible. Okay, there's only 10% chance they're actually going to pay us at this point. So you can see here that the weighing is going to be kind of backloaded. As these get older, you're going to have a higher percentage of like uncollectability. Okay, so this is a more accurate way of doing this, because you're kind of you're doing a more common sense approach and looking at the details of your account receivable and doing a risk weighting. Okay, the older ones are riskier than the newer ones, and you can see that reflected here. Now, of course, these percentages are at the discretion of the business. They're gonna come up with some way or method of getting to these percentages. Okay, and that's an analysis that some accountant is going to do in the business, and look at old records and see how often, if something got to 60 to 90 days, what percentage of them ended up paying. There will be some analysis to get to those percentages, but it's at least going to follow this general trend of riskier as things get older. Okay, so now we apply these percentages to each of these buckets. You can see here. And you can see that most of the accounts receivable are in this newer bucket, because, it's probably trade receivables and they're given 30 days to pay. And so most of the accounts receivable are in there. And, most of them pay, because you can see how many of them make it to this next bucket. It's a much smaller percentage. And then how many make it to here. Actually, this one, it looks like there's one guy who's kind of lingering here. Okay. Um, but typically you'll see also a decline in the balances as the age goes out. Okay. And then, so you apply these percentages, and then you get, based on these, to a target balance. So it's the same thing. Now, this is going to be the balance target for allowance for bad debt. And then you just do the same procedure. So the only difference now is that we have this table and the risk stratification. That's the only additional new thing. Once we have this 185, we can then look at our existing unadjusted balance in allowance for bad debt. This is our new target balance, and then we would just calculate the adjusting entry the same way as we just did. Okay, so let's do a practice problem with this. You're going to be given a table like this, and you'll just have to figure out what this target balance is based on that table. And that's the only new thing. Once you have that target, it's the same thing as we just did in the last problem, because you now have the target for allowance for bad debt.